Whew. Multiple things going on all of a sudden to impact the real estate market in October. Listings taking price reductions, buyer demand that is declining, sales rate that is declining as well. Now, increasing inventory in a lot of areas. And the Uber umbrella is that there is economic chaos with the bond yields and the recent war breakout in the Middle East. Whew. Amidst all of this, I got some great news if you are a buyer or a seller and how you can potentially navigate this market to come out as a winner. All in all, we do have a rock star market update. Are you ready? Let's go check it out. Hey, Ravi with the 𝗧𝗵𝗲 𝗖𝗶𝘁𝘆 here. If this is the first time we're connecting, I welcome you to my channel wherein I strive to provide meaningful, relevant, and educational content to keep you in the real estate now. Now back at it. Let's go through the list one by one. First, the price reductions of listings across the entire country, which is increasing. As we see here, 38% of the homes listed nationally are taking a price cut every week. Now, that means over 2.5 weeks, 100% of the listings, if they stayed on the market, will take a price cut. In April of 23, it was just at 29% where the homes listed took a price cut. Now it is at 38%. So the key right now is to price homes accurately. Now is not the time to actually throw and see what sticks. Also, if the price of the competition around a specific listing is continuously cutting their price, that means your home's price is also going to decrease, right? This is relevant in current market because buyers are making decisions based on what is available on the market rather than what sold about a month or two ago, okay? Then moving on to talk about the demand that is declining as well. The purchase mortgage applications have dropped to the lowest level since May of 1995. The demand is down and it has everything to do with the rise in interest rates. Rates are likely to increase further and remain elevated for the foreseeable future, meaning the demand is likely to continue to decline. That was from the financial circles, by the way. We may be in the 8% interest rate range for a little while, which is the prediction. And when the rate does touch 8% or higher, psychologically, buyers may pause, correct? What do you think? Comment below and let us know. Would love to hear your thoughts. Then moving on to home inventory. There's been a slight increase in inventory nationally. Now, this is not because more sellers are listing their homes. It is because there is less buyer activity. Next, let us look at the declining sales rate across the different regions in the US. Now, this graph does not talk about the price of units or the dollar volume of sales. It purely is the number of units sold, okay? Normally, home sales volume of around 5 to 6 million units is a healthy and a busy year for the market. However, the number of homes sold this year will just be around 4 million, which is low by all standards. Next, I wanted to share a snippet about the economic chaos that happened over the last week with the 𝗵𝗲 jobs report, ousting of the House Speaker, upcoming government shutdown, which is looming, and the like, by 𝗧𝗵𝗲 of Navy title, who's got some golden nuggets of information that she'll be sharing with you. Now, you may want to pay close attention to what she shares. Here goes.
All right. Okay. Now we're getting into the nerdy stuff that is driving our whole market. So we've had a lot of things happen. I know last week we spent a little bit of time talking about, kind of the upset on Capitol Hill with the ousting of our Speaker of the House. And so a lot of concerns, and that spooked the market and pushed our rates up. And what that basically meant, and what investors were starting to do, is they started dumping their bonds. They were pulling back on purchases. They were like, what does this mean? And the biggest concern is, is Congress going to be too focused on electing a new speaker to not pay attention to our looming debt ceiling? Because the Band-Aid that we got for our debt ceiling expires on November 17th. And so some investors were saying, okay, you guys are fighting among yourselves. I don't have confidence that you're going to get this figured out before November 17th. So make the markets seem desirable for me, the investor. That pushes up more rates, and so now when we start seeing our treasury rates going up because they're dumping the bonds, that pushed us up. We hit 4.8% on our 10-year. And when you look at the 10-year yield, and if we're at 4.8%, so when the 10-year goes up, that actually will push mortgage rates higher. And so there's always a spread between the 10-year yield and mortgage rates. Usually, historically, it's been 170 basis points. Right here, we're holding strong at 300 basis points. That's why so many of us have been like, rates are going to come down. Why are they going to stay this elevated? This spread is so unusual and it's been so big for so long that's why so many of us are like, it's gonna, I mean, come on, it's gonna come down, right? We look at the data and it hasn't yet. So could it tomorrow? Sure. Or not, we don't know, but everything that's happening. And then, so we've got all the thing on Capitol Hill. Then we had our jobs report come out on Friday, and it was shocking, nearly double the expected jobs. And that does not make the Fed feel like they're cooling the economy. What's interesting is I guess most of those new jobs are in one sector, but the way they're looking at it, and mostly in the service sector, and the way the Fed's looking at it is they don't want to see rates or incomes going up too high because that pushes inflation. However, when you see something like this many new jobs, it basically all but indicates that the Fed is going to raise rates. And then we have what happened this weekend with Israel, and there's different conversation of who's behind it. I know that Hamas is taking credit, but it's getting real messy really fast, and it has every ability to impact global oil prices, which then impacts everything else. And if those are pushing up, then we are looking now at more, higher inflation. Then we're going to look at the Fed pushing rates up. So, it's not necessarily like, here's the cause, here's the effect, but there's definitely direct correlations between what's happening and then what our buyer's mindset will be. In addition to the fluctuation with our mortgage rates, it's freaking people out. And just like what Teresa said, is so many people are watching what's happening on the stock market or what's happening in different, in just any different markets. And they're going to pull back because anytime anybody senses insecurity or instability, what do? They pause. And that is where we are right now.
So let me unpack this all. That was great. Thank you. So number one, I'm sure all of you know that 100 basis points is 1%, right, Sarah? 100 basis
yes.
points, 1%. So the 10-year Treasury, you can pull that up at any time and see, is kind of there's the 2-year, 5, 10, and 30-year. But look at the 10-year, and as Sarah pointed out, typically mortgage rates will be 180. I think it's 180. Is that right, Sarah? 180 basis points over the 10-year. Is that the typical? 170. So 170. So add 170 basis points to 4.8, and that's 5.8 plus 7 is what? 5.8, 6.8. So it'd be 6.5. So we should see, I think that's right. We should see about 6.5% now, but instead we're seeing like 7, 8. So that's really about a 300 or 3% basis difference spread right now. And typically you see higher spreads when you have more uncertainty. Typically you'll see a higher spread when you have more uncertainty in the economy and in the market, and that's what's happening right now. So that's just my little take on it. And then yes, they were predicting 170,000 job openings, and it came in at 336, which made everybody pretty much feel like the Fed is almost sure to raise rates in November.
So that is how the financial picture is looking at the macro level. And now let us tie the national picture into what is happening locally across the 3 counties, King, Snohomish, and Pierce, shall we? Now, the number of new listings in King County decreased by about 19.9% year over year. And the data was similar in Snohomish and Pierce counties as well, which saw a decrease of 26% in the new listings. Now, interestingly, while the new listings for single-family homes was down across the 3 counties, condo market in the King County saw more condos come on the market, about 10% more, that is, compared to the last year. We're also seeing that many homes that are going under contract are failing to close due to the buyers having a change of mind or buyers losing their jobs, etc. And the lending regulations growing tighter as well, contributing to that number. The number of days on market decreased by 12%, and this was due to homes going under contract much sooner. Even though the interest rates are high, homes in pristine condition and those that are priced right are still selling within 5 to 6 days post-launch, whereas homes that have a rental cap, assessment issues, etc. are staying on the market longer. The median price Moving on to the median price in King County, which increased slightly year over year to $900,000. Now, median price, as you know, is at the dead center with equal number of homes priced above and below selling. Now, there were more homes in core areas like Bellevue, Redmond, Kirkland, and 𝗧𝗵𝗲 that sold to help put this number up for September. Then moving on to the average price, which also increased slightly year over year as of September, as the inventory is still low and homes in the 1.2 to 1.6 million price range, pulling that number up. Now, the list to received price was at 100%. Now, more homes were selling at list. This is due to many homes that sold getting one offer probably at ask, and the sellers also unwilling to take anything less, capitalizing on the low inventory. Now, inventory of homes for sale in King County decreased by 31.9% year over year, and the other two counties also saw decreases in the 35 to 42% range. As we saw, sellers are capitalizing on the low inventory, and most of the sellers, barring any issues with their homes, are getting what they're asking too. Now, the months of inventory of homes is still at less than 2 months, which means it's still very much a seller's market. Now, inventory less than 3 months is a seller's market, between 3 to 6 months is a balanced market, and anything above 6 months is a buyer's market. As we know, months of inventory is how long homes for sale on the market will take to sell, assuming no new homes came on the market. Just a refresher. So the key takeaway is that if you are a buyer in today's market, you have an advantage to beat out the competition and buy the home of your choice, because when rates drop, guess what's going to happen? That's right. Buyers who are sitting on the sidelines are going to come back right into the market in droves, and multiple offers are going to become the norm again. So you may want to think about buying now and possibly refinancing later. And if you're a seller, make sure that your home shows great, is priced and marketed well for you to get the most amount of money. Hey, well, that's a wrap. If you found the information useful, consider subscribing to my channel and hitting that bell icon to get notified every time I put an update. I hope to keep you updated on what's happening in the real estate market, and thanks for your support. I've included the data for all the 3 counties, King, 𝗧𝗵𝗲, and 𝗃𝗲, below for you to slice and dice. And if you need any deeper insights, feel free to text, DM, or call me, and I'm happy to get that information for you. That said, until next time, you stay safe, and I'll connect with you soon. Bye.